Let's be real, most people don't think twice about financing a car. It feels normal, even responsible. You walk into a dealership, they run some numbers, and boom, you're driving off in a brand new ride. But what if I told you this everyday decision is quietly wrecking millions of Americans' financial futures? It's called being car poor, and in 2025, it's one of the biggest wealth traps out there. Here's the reality. The average new car payment in America today is $745 a month. That's nearly 20% of the average take-home income, double what financial experts recommend. And remember, that's just the payment. Add in insurance, gas, and maintenance, and suddenly, transportation is eating up a quarter of your paycheck. For a lot of households, that's more than they spend on food. So what does being car poor actually mean? It's simple. Just like being house poor, it means your car payment is so big it strangles the rest of your financial life. You can't save. You can't invest. You can't breathe financially because every extra dollar is tied up in a depreciating asset. And here's the kicker. Cars lose value the second you drive them off the lot. Unlike a home which can appreciate, a car is guaranteed to go down in value. Worse, many people are upside down on their loans, owing more than the car is even worth. Imagine paying $35,000 for a car that's worth $28,000 the moment you try to sell it. You're trapped, paying off debt on something that gets less valuable every single day. And yet this problem keeps growing. Why? Because four hidden forces are pushing Americans deeper into the car poor cycle. So why are so many people ending up car poor in 2025? It's not just bad luck or poor money habits. There are four hidden forces at play. And unless you see them clearly, it's almost impossible to avoid the trap. The first one is easy credit. Buying a house comes with rules, checks, and paperwork. But with cars, dealers can get you approved in minutes. No income verification, no real regulation, just a signature and you're locked in. To make the payment fit, lenders stretch loans to 7 or even 8 years. Think about that. You're paying off a car for nearly a decade, long after its value has tanked. It's like signing up for a financial treadmill you can never step off. The second force is status pressure. Let's be honest. Cars in America aren't just transportation. They're status symbols. Social media, marketing, and even peer pressure push the idea that your car equals your worth. People feel judged not by their bank accounts, but by what they drive. That's why someone making $50,000 a year ends up with a $50,000 car loan. They're buying an image, not a tool. Third, there's ignorance of affordability rules. Most Americans have never even heard of the 24-10 rule. Put 20% down, finance for no more than 4 years, and keep your car expenses under 10% of gross income. Instead, people walk into dealerships asking, "What's the monthly payment?" And dealers know how to stretch numbers to make it work, even if it ruins your long-term finances. And finally, there's car-dependent culture in the US. Cars aren't a luxury, they're a necessity. Public transit is limited in most places, so people feel like they have no choice but to buy, even if it means overextending themselves. At first glance, a car payment doesn't look like the end of the world. After all, millions of Americans have them. But when that payment balloons to $700 or $800 a month and stretches over 7 or 8 years, the ripple effects on your financial life are massive. Here's the first problem. It kills your ability to save and invest. Every dollar tied up in a car payment is a dollar that isn't building your emergency fund, going into a 401k, or compounding in the stock market. Over 8 years, a $745 monthly payment adds up to more than $71,000. Invested instead, that could easily grow into 6 figures. Instead of working for your future, that money evaporates into a depreciating asset. The second problem is negative equity. Cars lose value the second you drive them off the lot. Within 5 years, most vehicles have lost half their value. But if you financed it over 7 years, chances are you still owe more than it's worth midway through the loan. That means if you try to sell or trade it in, you're rolling debt into the next car. It's a debt snowball rolling in the wrong direction. Third, being car poor creates lifestyle pressure. Once you've locked into a big payment, your monthly budget tightens. You start relying on credit cards for emergencies, racking up high-interest debt just to cover basic expenses. One unexpected job loss, medical bill, or rent hike, and suddenly, the car you needed is the anchor dragging you underwater. And the worst part? Cars are a guaranteed loss. Unlike a home which can appreciate or an investment which can grow, a car will never make you money. It only takes... The good news is you don't have to stay care poor forever. Escaping starts with changing how you approach car ownership. not as a status symbol, but as a utility. Your car should get you from point A to point B safely and affordably. That's it. The first step is following the 24/10 rule, a simple framework almost nobody teaches. Here's how it works. Put at least 20% down so you don't start underwater. Finance it for no more than 4 years so you're not still paying for a car that's falling apart. And keep the payment under 10% of your gross income so it doesn't strangle your budget. Follow this rule and you'll never get trapped in a loan you can't handle. Second, buy used, not new. The biggest hit to a car's value happens in the first 2 to 3 years. By buying a reliable used car, you let someone else eat that depreciation while you keep your costs lower. Modern vehicles are built to last 150,000 to 200,000 miles or more, so buying one with 40,000 miles isn't risky. It's smart. Third, look at total cost of ownership. A cheap sticker price doesn't always mean a cheap car. Insurance, gas mileage, maintenance, and repairs all add up. For example, a luxury car might cost the same monthly payment as a Honda, but servicing it could drain thousands more each year. Always factor in the long game. Finally, break the cycle. If you're already car poor, your best move is to finish your loan, keep the car, and drive it for years after it's paid off. That's when the real savings start. No payment, just freedom. Imagine this. Instead of dropping $745 a month on a new car, you drive a reliable used vehicle for $300 a month. That's an extra $445 freed up every single month. Over a year, that's $540 you can save or invest. And over 10 years, that's $5,400, not counting potential investment growth. Now, picture putting that money into a simple investment strategy, like low-cost index funds or ETFs. At an average 7% annual return, your $5,840 per year grows to over $75,000 in 10 years. That's the power of avoiding unnecessary financial drains and redirecting funds to wealth-building assets. Beyond the math, there's a psychological benefit. You're no longer living paycheck to paycheck, scrambling to make payments or stressed over car repairs. Instead, you gain financial freedom and peace of mind. Every dollar you save now compounds, making your future choices easier and your long-term goals achievable. Avoiding the car poor trap is about intentional decision-making. Every loan, every monthly payment, every purchase, ask yourself, will this bring me closer to wealth or keep me stuck? Spoiler, flashy cars rarely accelerate wealth. Practical, affordable choices do. It's also about culture. Society tells us we need the newest car to signal success, but the wealthy know real status isn't a shiny vehicle. It's financial security, freedom, and options. Driving a modest car while your investments grow quietly in the background is a hallmark of smart wealth building. So here's your takeaway. Don't let cars control your finances. Follow affordability rules, buy used, calculate total costs, and redirect the money you save into building wealth. The car you drive won't make you rich, but the money you save by avoiding car poor will. Start today. Make one smarter car choice and watch how quickly those freed up dollars begin working for your future.